Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, talk to them about their background, how they evolved through the financial industry, what sort of formative lessons learned they experienced along the way. We'll talk to them about their process and their routines, how they analyze the financial conditions and develop an investment thesis, and finally, observations about the current market environment. What's their outlook? Where are they seeing opportunities? Where are they seeing risks? A really fun interview today with fellow technical analyst Andrew Thrasher. Andrew is a chartered market technician, a CMT charter holder, also a two-time Charles H. Dow Award winner. That means he has written research that has been well received and recognized as a top contribution to the technical analysis community. 2 years here, which is a very small group of people that can say that about their contribution to the technical analysis body of knowledge. Great conversation with Andrew today about market conditions, about breadth, which is one of the key parts of Andrew's approach, some of the key takeaways from his foundational research, his award-winning research, and a lot of great conversations about investment, best practices, routines, and the best way that you can analyze charts and develop an investment thesis. Please enjoy this conversation with technical analyst Andrew Thrasher. Super thankful to be sitting down today with Andrew Thrasher. I've known Andrew and his work for quite some time. Andrew's the portfolio manager at the Financial Enhancement Group based in the Indianapolis area, also the founder of Thrasher Analytics, where, as far as I can tell, he shares great experience and insights with people that need to hear him. Andrew, great to see you. Welcome to the show.
Hey, thanks for having me back.
We mentioned before we got started, we're recording this just after the Ohio State-Purdue game. I promised you we would not talk too much about it. I just want to acknowledge you're a Purdue alum. Great to talk to a fellow Big Ten alum, as always.
Yes, we're more looking forward for the basketball season. We're putting football season behind us now.
There we go. Fair enough. So I'm excited to sort of chat markets with you, chat process with you, but I'd first like to just talk about your journey. Because I think of you as one of those people that is really advocating for the technical analysis community. You've sort of spread the good word of how these tools and techniques have helped you. You're working with investors and managing money based on these concepts. So I think it would be really helpful to just understand a bit about your background. What can you talk to us about sort of your formative journey toward getting to where you're at, particularly how you were introduced to technical analysis and what drew you to that particular set of tools?
Yeah, so I went to Purdue, as you said. I got a degree in financial planning. My father was a financial advisor, and so always had that kind of interest in the stock market. Had initially started out just getting a general business degree, then moved over to financial planning, and eventually then after graduating from Purdue, worked for a financial advisory firm in Florida. The founder of the firm was really big on education, wasn't overly concerned with kind of where you got it, just as long as you were pursuing something, whether it's a designation or just building up a specialty and a skill or something like that. And so I started just really getting into, started reading a lot of the Graham type stuff, and it just wasn't clicking, as a lot of people are. Really, the fundamentals weren't really clicking with me of how that moves the market. And so started getting a little bit, that's when kind of financial Twitter was still pretty much in its infancy at that point. This was about 2009 when I graduated. And so started getting a little bit involved in that, seeing people talk about charts, learned what the chartered market technician was, and then began pursuing my CMT, which took 3 years to do all the different exams.
Yeah.
So just after getting into the CMT, really kind of diving headfirst into that, learning that process and kind of the curriculum there was I would say was my foundation in technical analysis, and then have continued to build on it from there since earning the designation.
When you that's awesome. And I mean, what a great benefit, how fortunate to be at a firm where the founder or the person in charge values education, right? And values improving your toolkit. Not everyone has that benefit. I'm glad that you did, for sure. When you learned about technical analysis, and particularly when you got into the CMT exams, you and I have both done them. It's a journey. I mean, it's a marathon of hitting a lot of different things. Was there a moment along the way where things kind of clicked? Was it an early on, yes, this makes sense? Or was there a particular sort of approach or technique where you said, okay, that makes sense, and you realized that was going to be something that would be core to your process going forward?
It's something that those that are close to me know. I've kind of an obsessive personality. So when I start getting into something, I fully immerse myself into it. As I was learning technical analysis, I was waking up, I think around 1 a.m., 2 a.m. to trade European Forex markets using technical analysis and day trading
Nice.
Forex, trying not to wake up my wife, or her puppy at the time. And so just really got really into applying it and drinking kind of from a water hose, as a lot of people do when they get into technical analysis. There's just so many tools, so many forms of analysis, from sticking a million different technical indicators. And so I think it was really trying to parse through all of that and learn really what they were and how they could, most importantly, work together to form a strategy. And then just throughout my career, I've shifted now to a firm that I've been with now for the last 14 years in Indiana,
Yep.
and working and building strategies there, and really trying to cut away as much of the noise. And I think in this type of market, it really is beneficial as we kind of get an increase in noise, whether it's political or news or social media or what have you, and really allow yourself to focus on what's driving price action. I get a lot of questions on social media. Okay, what do you think of the impact of XYZ? And
Yeah.
thankfully, as a technician, I can say, I really don't care, or I don't know. The next GDP release, I don't know, but
Yeah.
we'll see if there's more buyers or sellers. If we hit support, it makes the process, I think, a lot simpler. You don't have to
Yeah.
be an expert in economics or an expert in geopolitics. You can just try to combine the art and science of technical analysis and let that be what drives you. At least that's what
It's
drives me.
It's so funny, Andrew, because I feel like a lot of people, when they struggle to make sense of the markets, they're trying to like upgrade their crystal ball. They just think that,
Yeah.
it's like trying to make sense of all these potential drivers. And I always tell people, like, it's not about that. Like, it's just open your eyes and your ears and pay attention to the trends. I think it's a lack of market awareness that gets people more than a lack of, fortune telling, for what it's worth. And I think what you described completely completely supports that. When I think about you and your work, Andrew, there's always been, from my perspective, sort of a focus on risk management, and we'll
Mhm.
get to like the Charles H. Dow Awards, dealing about volatility, dealing about potential like topping signals.
Mhm.
But was there an early formative moment where the lack of risk management hurt you, or a bad trade that was like a wake up call for you, or were you able to avoid those early painful lessons in some way? Was there that like wake up call moment for you about the value of risk management going forward?
Yeah, gave me kind of the focus, and what led to the first Dow Award that I won, that focused on volatility, was the firm I work for, a wealth management firm in Indianapolis. We primarily work with retirees. Their
Yeah,
goal isn't so much asset accumulation, it's more preservation. It's families
got it.
that have built up variable amounts of wealth, and they're trying to either develop income streams, pass on assets, things like that. And so while we very much focus on asset appreciation, our main priority is really trying to minimize that volatility of their portfolios and protect those large declines. And so that's something we're often discussing as a team, and what led some of my research and my focus on risk management tools, as that's kind of really what a lot of the families that we work with, yeah, they want to grow their accounts, but they would much rather not see it get cut in half.
Yeah, that's right. That's right. And it's so funny. I find too many people too often think about capital appreciation, capital growth as like the goal, and forget that capital preservation can be a really meaningful goal at
Mhm.
certain parts in the cycle, for sure, more than others, right? You'd mentioned the Charles H. Dow Award, and we should celebrate the fact that you are in a very small community of people that have won that award twice, correct? And that's the CMT Association awards that, the Dow Award for new research, kind of
Mhm.
building the toolkit of technical analysis. Your first research paper was about volatility, right?
Mhm.
And can you summarize, like, what was the general takeaway of that, and also sort of what inspired you to take that step? Because I know for a lot of younger strategists and technical analysts, being able to create research that would win a Dow Award probably seems unreachable. What sort of inspired you to take that step?
It was actually writing a blog post. I used to blog a
Nice.
lot at athrasher.com, and I started
Yeah.
writing something that got way too long for a blog post. And that's kind of where it started. I blogged a lot, and I got really into the VIX. Again, looking at risk management,
Yeah.
seeing, okay, when VIX spikes is often when we see some of these larger drawdowns in the equity market. And so I say, okay, is there anything that precedes these big spikes in volatility, and with it, drawdowns in equities. And so kind of parsing through that and looking at a lot of different types of data and reading a ton of other research on the topic, not wanting to replicate something that reproduce the wheel that had already been made, had found that when we started seeing what the paper, it's called Forecasting of Volatility Tsunami, when we go into these really, really quiet periods of volatility, when what I use is standard deviation, when the standard deviation of the VIX gets really, really low, I view that as kind of the sentiment towards volatility is overly bullish towards equities, overly bearish towards volatility, in that you're not seeing the VIX move really at all. And so that overconfidence in sentiment towards equities, or negatively so towards volatility, kind of gets this quietness in the market, and the kind of the supposed ball push underwater kind of builds up that pressure. And what we found is just about every single spike in volatility is preceded by these conditions. And so it's made it a lot of fun, because we see volatility spike a lot. We saw it just a few weeks ago before this recording, where it went from the teens up to near 30, and that was preceded by a compression in volatility as well. And so we see that not every compression leads to a spike. Nothing works that perfectly, but just about every meaningful spike is preceded by these compressions. We actually saw it before the COVID spike. We saw it before the big spike that everyone looks back at January, February of 2018. We look at all the ones that, looking back, it doesn't really look like there was a lot of conditions involved. They all had really, really tight compressed volatility, and then that pressure releases and the VIX spikes. And so originally it was trying to find when the volatility rises, and it got to be too long for a blog post. So I kept formalized into a paper and said, well, I could submit this for the Dow Award, and did, and was surprised a couple months later to get the call that it had won. And it was a very honored to receive the first award that I received.
Yeah. So, you know what? That's so interesting, because I remember reading, this was probably like Josh Brown or Barry Ritholtz, or one of those like early financial bloggers. I remember seeing an interview they did at one point, and they were asked about, like, why do you blog all the time? And they just said, well, this is what I do. This is my process. Like, I write, and that's how I make sense of the markets. That's how I synthesize all the information. So it's interesting that for you, it came from a process of writing and writing consistently, and look what came out of it. Good lesson, I think, for hopefully younger people. I always tell people it costs almost nothing to start a blog. Even if you don't share the link with another human being, get in the process of getting your ideas down and synthesizing and summarizing and all of that. I think that's
I think for people that are trying to write research, it's not writing with the end goal in mind. I want to write for this competition, and there's other ones out there. The paper that I wrote that won the second Dow Award also won the Founders Award. There's all these different things you can submit papers to win research, and not starting with that as the goal. Really started as something that you're curious or interested in, and develop that topic. And if you realize, okay, maybe this could be something, but not pursuing it just for that sole purpose.
It's great comments there, Andrew. Your second paper that won was on I think it was called the 5% Canary, because I remember reading that one, and that was, if I'll try to summarize, and probably ask you to summarize, but my takeaway was that initial drop of 5% within a pretty short period of time was kind of a classic topping signal. Is that one of the takeaways, or is that the idea?
Yeah, and again, that came from being a portfolio manager. The families that we work with aren't really concerned with 2, 3, 4, 5% declines in their portfolios or the market. Was really looking at what type of conditions preceded large declines. Again, looking at risk management. And so it was, what I found was, when we start seeing the market move really quickly in a very short period of time on that initial descent, is what can often precede larger declines. When the market takes a really long time to really slowly decline by 5%, it takes 2 months of these whipsaw back and forth and eventually eclipses 5%. Those don't really have a lot of selling pressure behind them. It's the declines where we really see it happen within just a couple weeks, where we really see a lot of selling pressure to push a major index like the S&P 500 down. That builds up selling pressure. That gets people to jump in behind them, start selling and pushing it even further. And then the paper that I wrote found that when we get those 5% declines in just a couple of weeks, and then get confirmation by crossing soon after the 200-day moving average, is what has preceded a lot of the largest declines that we've had. We had it occur between 2022, 2027. A lot of the major declines see these conditions met. And nothing's perfect, just like the VIX paper, nothing's perfect. Not every single one of these canaries triggers a massive market meltdown. Thank goodness. But it's just another tool that I use, and thankful that I've seen a lot of other investors now use as well to analyze the market. And it also, the benefit I use it, and a lot of comments I've gotten back from it that have been positive, is it allows you not to be overly concerned with the tiny little wiggles of the market. Oh, we pulled back 3%. For me, for my time horizon, the money that I manage, 2-3% is not going to wake me up at night. But when we start really getting material moves lower, that's when we want to start possibly taking action within our portfolios.
You'd mentioned earlier, Andrew, that the volatility compression makes a ton of sense. I mean, earlier this year, we saw the VIX being, remarkably low consistently. Then we started to see some big spikes in that. But we haven't seen that 5% canary pattern here more recently, right? And so what would we need to see? And I want to talk more about the current markets here in a bit, but what would we need to see to trigger that? It would be a more significant sell-off in a shorter period of time, and then breaking the 200-day was part of that sort of thought as well, right?
Yeah, we had when we had the decline in April, we actually had the 5%, but then we were so far extended that to get to the 200-day would require the market to already drop so far. So when the market's already really stretched, and we're just here recently, we got to about 13% above the 200-day moving average. You have market conditions like that to where by the time you get to the 200-day, you've already had a double digits decline. And so you have just certain market conditions where to get that confirmation, you've already had a pretty severe sell-off for this kind of market, where a 3% decline gets us breaking news on CNBC, to where you have to evaluate kind of the market we're in. If it's already overly stretched, it's going to be hard to get that confirmation. So right now we're basically sitting just under the highs. So I think we're off by like 1% or 2 in the S&P. And this is just something they're only using the S&P. In the paper I show, it works on other developed markets. It's not a tool I use in the NASDAQ or small caps. They're just too volatile. 5% is nothing for the NASDAQ to decline by. So it's really looking at the markets like the Dow or the S&P, which I use in the paper, that those two, a 5% move in the S&P or Dow is pretty significant type volatility type move in those markets.
Can we talk to us a little bit? I mean, you've shared some of your research. Talk to me a little bit about your routines, your process, right? Your day to day. You strike me as someone, you always have something to share on your blog. I remember reading that. On social media, you've always shared generously with things you're seeing and stuff. What's the process you go through to evaluate conditions? Is there a morning routine? Is there a consistency to what you do, or how are you able to synthesize the data? What kind of approaches do you use?
Yeah, good question. I am very routine based. Every day is specific. Today was my sentiment day. Today's where I went through. I go through the daily sentiment index, all those data, all that numbers. I have custom sentiment indicators that I developed for all the sectors and futures markets. So going through all those is typically what I'll do on Tuesdays. Typically Wednesdays are my breadth days, where I spend basically the entire day in my chart book of breadth data. I'm really in the breadth chart book almost every day. And if you follow me on Twitter, I'm always tweeting about VIX and breadth, and it probably people probably get tired of it. I know my team does. When we have our Monday allocation meetings, it's all I talk about is breadth, especially right now. It's, I think, the most important thing people should be watching. But I do a lot of my research actually on Sunday, where I can market. I've got a full week of new data on for the weekly charts, and I spend probably 4 or 5 hours on Sunday. Go to church, come home, eat lunch, and I'm at my desk pretty much the rest of the day. Going through things and writing. And that's when I do probably my longest research piece for Thrasher Analytics, gets published Sunday night, updating all of my models. I try to do 2 or 3 charts that are the most important that I think for the market that week, my 2 spotlight charts, and try to really synthesize the data down for primarily the people that subscribe to Thrasher Analytics are financial advisors, hedge fund traders, institutional investors, or individual traders who have access to a lot of data. I try to give them what I think are the most actionable, most interesting things that I'm watching. And then throughout the week, I'm continuing to kind of track some potential setups in our portfolios, doing a lot of trading. But yeah, probably my process is really heavily driven on Sundays, and then Tuesday, Wednesday, do a lot of research as well. Monday, I have meetings, so I'm talking to people most of the time on Mondays. And then just trading, and I'm in the accounts in the portfolios the rest of the week.
And when you, I mean, because obviously you have Thrasher Analytics where you're sharing ideas, sharing context and observations, but with your money management role. I mean, you're actively managing portfolios. Do you
Yeah.
find that the clients of the firm, I mean, are they aware or open to technical analysis? Is that a familiar concept, or is that a foreign thing that you have to often translate as to here's why we're thinking a certain thing? Like, what's the appetite for people that you're working for technical analysis and the types of work that you do?
Yeah, I think kind of answer it in two different ways. One, again, I work in Indianapolis, and so not to speak for all financial advisors in the Midwest, but the clients that we work with really don't care. They really true in the sense of
Not to
they want
generalize about the whole region, but I get it. Yeah. Okay.
they work with us because they don't want to worry about their money anymore.
Yeah.
They worked as either small business owner, doing whatever it is they did to build the nest egg that they created, the retirement account they created, and they were really good in their industries. And now
Mhm.
they want to help with. We do a lot of tax work, a lot of tax strategies with our
Yeah.
families, and they just don't want to worry about it anymore. They come to their meetings, they get some of the content we produce, and we try to give them kind of the broad level to a lot of it. A lot of the content we produce is more trying to, hey, we know you're watching the news. Here's why this doesn't matter, or here's the
Mm,
things that you really should worry about. Hey, yeah, the government shut down. Here's historically what the stock market's done. It hasn't always been historically a bearish incident when the government closes down. Try to put a lot of data to what they're seeing to kind of ease either some of the fears or say, hey, here's some of the things that we're actually worried about
yep.
if it's that case. And so I do share a lot of technical analysis in that kind of a broader scope of things. The video I'm doing for clients this week is going to talk about breadth.
Yeah.
They're going to hear, but it's talking about highs and lows and in ways that they can understand it. And we do have some families that very much do care and they are interested. Maybe they manage some money on the side that they're still kind of passionate about picking some individual names. But a lot of the families really just want to know, am I okay? Am I on track for kind of the goals that I have set for our family? How you get there is less of a concern for
Mm.
most of them. They just want to know that feel like they can trust and trust in the process that we've set out, and then just have those high level conversations when needed.
I would imagine having someone like you, having access to someone like you to put their minds at ease is probably a really good thing for a lot of your clients. I would
Thank you.
imagine, Andrew, with your experience and perspective. So you've teased breadth a couple times. Let's go there and talk about breadth conditions, right? So
It's
since the
terrible.
end of June, I mean, it's hard. It's hard to. I don't know if you've looked at breadth indicators at all, Andrew, but no. There's certainly been breadth deterioration, right? The market's been making new highs, S&P and the Nasdaq new highs every month, but I feel like every new high has been marked by some breadth indicator not confirming that. What do
Yeah.
you make of that sort of broad breadth divergence, and kind of how does this resolve, right? Because we're still in the situation where the S&P is pretty near its all-time highs and the breadth is still pretty bad.
Yeah.
How do you sort of reconcile that, and what's next? Or how does this sort of what's the next step, do you think?
Yeah, so I think the one thing with breadth and why some people may kind of ignore it is because people will talk about it and the market doesn't respond, or I'll even write the market doesn't care because
Yeah.
breadth isn't a signal tool to me, and to
Mm,
most technicians, it's an environment tool. It's telling
mm,
us if we were trying to predict the weather, it's saying, hey, there's a lot of clouds in the sky. That doesn't just mean it's going to form a tornado and it's going to knock down your house, but it's telling you there's characteristics of in the weather right now that could produce a tornado that could kill you or could knock down your house. And so I liken that to breadth. That hey, the market doesn't look great. The clouds are kind of dark, but we haven't started seeing signs of the clouds of the wind starting to change and starting to see that funnel formed. And that comes
mm.
when we start seeing price respond to the breadth. We saw a perfect example of that in 2021 for Q3, Q4, and really heavily in Q4. The market just looked terrible below the surface. It
Yeah.
was we were running on. It started as 20 stocks, then it would go to 10. By the end of the year, it was basically whatever two stocks did drove the market. And then we lost those two and we had a bear market. And so
Yeah.
I spent a lot of time with our advisors being like, this looks awful. This looks awful. Like, okay, what are you doing in the portfolio? And they say nothing. It's like, what are you, and they tell me, oh, well, explain that.
Yeah.
And then how do we talk to families that, well, the market hasn't responded yet. And so,
Yeah.
and that's kind of what led to bringing in like my 5% canary saying, okay, the market looks really bad. If we
Yeah.
see the market decline by 5%, we start seeing support levels, see signs of confirmation, confirm that bad environment. We start seeing that funnel start to form. Then we know, okay, this is where we need to start acting. We don't need to be investors that sell at the absolute top. We want to see price
Mm.
confirm by a little bit. And then that's when we start to take action, because we're really only concerned with those, what we potentially could be very large declines. And sometimes we'll prepare for one and it ends up being shallow and we get back in, but we always want to be prepared for what could be.
Mm,
And so I think right now, breadth to me looks terrible. Other technicians that I highly respect strongly disagree. But when I look below the surface, one chart that I just did today that I might post to Twitter later, maybe not, is looking at the net new high list for the S&P 500. So the net new 52-week highs minus the lows, and
right.
seeing that when the market was less than 1% from its high, it was net down 17 points.
Yeah.
And that was the lowest since December 1999. It got net
Oof.
7% in October 2018. Well, that preceded bear market. Got 17% in December 1999. Pretty much everyone knows what happened in 2000. So again, not to say that's what we're going to repeat, but it's showing
Yeah.
how lack of participation, and it is truly a market of individual stocks. We'd like to see that broaden out, see a lot of stocks rising and moving higher. One chart I have shared is looking at, since the market declined back in the first quarter of this year, we had 67% going into that decline. 67% of the large cap stocks were positive year to date. We've never gotten back to that level. Since the decline in April, we've never gotten back above 67%. In fact, it's continued to roll over here recently. So we just have that leadership of just a handful of stocks. The top 3 stocks account for about 83% of the gains in the S&P 500 year to date. It just depends on what NVIDIA is doing. And so I think that can continue for an undisclosed amount of time, but it's really concerning, because if something were to happen with those leaders, there's not a lot of other stocks for the market to fall back onto. We can't see the market go higher on utilities. The market's not going to go higher on industrials when technology accounts for 50% of the market, and technology in those handful of stocks account for over 50% of the GDP in the US from size perspective. They're just too massive. And so that gives me concern. The market isn't concerned, as it reacted to it yet. And so we are invested. We still keep exposure until we see the market respond.
Yeah, I always tell people, right, remain invested until the chart tells you it doesn't deserve a place in your portfolio
Right.
anymore. And these charts seem to still be going up. You hit a couple times, Andrew, on what I think is a kind of crucial takeaway here in November of 2025. Through the course of the year, we've had obviously more and more of a concentration, a very top-heavy benchmark. Breadth indicators, kind of by definition, are all equal weighted, right? They're sort of looking at a basket of stocks and how many are thumbs up or thumbs down. How does that over concentration in the benchmark, has that changed the way you think of breadth, or do you see this? I mean, because people would argue the market's fine because the AI trade is kind of still working, and I mean the last week or two it's felt a little less impervious, but it's still overall pretty good. How does that over concentration and that over reliance, arguably, on that one theme, how does that relate to the weakness in breadth? Because I think those are kind of complementing each other, right? Narrow leadership, but still quite strong. So does that just mean the markets are vulnerable here to that one theme? How do you think about that?
Yeah, so what we look at as a portfolio manager, I'm seeing, okay, so the market's being led by these handful of stocks. What if the market does go down? Where are we going to see some resilience? And how I look at it is kind of a factor basis. So growth has been taking us higher. When we see the market go down, we see minimum vol do well. We start seeing value do well. And so able to maybe find areas of the market that currently are underperforming, but do have absolute and sometimes relative positive returns when the market's going down on whatever day NVIDIA isn't having a great performance. And so it's recognizing, and you saw a lot of that in the .com area, where someone like Warren Buffett, Berkshire, did terrible going into the peak, but then once the market turned, because he wasn't invested in tech, Berkshire started doing better. And so it's finding those areas that maybe don't have the exposure to the areas that are going to leak if we do see the market go down, those AI stocks like you referenced, and what has less exposure to that, and then kind of have your watch list for us, kind of ETFs and some individual names that could maybe be shielded and not as exposed to those corners of the market should the tide turn.
No, awesome points, Andrew, and I would 100% agree. And you're absolutely right. Because we've had a couple pretty decent down days here in the S&P and the Nasdaq in the last couple. Nasdaq been down 2%, and like the moment you see it, I know you're going to see the FANG sectors right at the bottom of the list. Sure enough, and you're seeing financials or healthcare or other things kind of popping up there. So 100% agreed on that. Those rotation comments. What about precious metals, right? From a technical perspective, gold, silver, far outpacing even the AI fueled frenzy with the
Yeah.
NASDAQ in 2025. How do you think about allocation to things like gold? It's kind of an out of benchmark bet for a lot of people, but a pretty stable place to be, relatively low correlations. How do you think about a gold positioning and position, and how do you think about it now that it's had such the run that it has, a little choppy more recently? What's the take on gold and silver here?
Yeah, so I like being able to have exposure to commodities. I have several in the portfolio right now. Some maybe more unique. Can't say which ones they are. Some that aren't as maybe household name commodities, and
Okay,
some that
sure.
are. We yeah. I think as far as people, I don't think gold should be viewed as something that if you just have a 1% allocation of gold and the market crashes, you're going to be fine because it's safe haven. It doesn't always work out that way. We
Yeah.
saw that during the inflation craze a couple of years ago. Inflation explodes higher, and gold showed it was not the inflation hedge they thought
Yep.
it was. And so
Yep.
I think it's really looking at commodities as if they were not necessarily stocks, but view them not as what they symbolize as a hedge for this or hedge for that, but as assets that it can appreciate. And so
Mm,
that's how I view them with our portfolio. If I think gold can go higher, it's not just because I'm trying to hedge inflation, or it's because I think um, whatever central bank is buying more gold. I don't care. Is it going higher or not? Again, I don't need to be an expert in geopolitics. I don't need to audit the Fort Knox of the Fed. Who cares? And
yeah.
so when gold got overextended, we did take action in our portfolios because that rubber band was getting really, really stretched. And
Sure.
so we looked at how much exposure we had and made a determination without saying what that determination was to our gold position.
Yeah.
Um, trying to be as compliance friendly as I can.
You're doing
Um,
great, Andrew.
yeah. So yeah, I think commodities can offer a lot of benefit in the right times
Yeah.
to correlation of portfolios. They provide. I think they can be a big help, but it's something for someone has to be fairly active in. A lot
Yeah.
of them you can't just sit and ignore them. A lot of them have negative characteristics because of future roll, and so you really have to understand what if you're using ETFs, what you own and how it operates. A lot of investors probably aren't going directly to the futures market if they can. Then you have to really kind of understand how that market works. So there are some nuances to commodities if you get outside of kind of your commonplace precious metals.
Yeah.
But I think the metal space, industrial metals, have done really well. Platinum, palladium has had killer trends. They've been great places for people to go this year for those that are trying to not just buy the AI stocks. Like you said, they've outperformed a lot of equities this year.
Yeah. No, some really thoughtful points in there, Andrew. And I love your comments about about just honestly, I feel like so many people feel they need to understand a lot of things about gold or silver, platinum, whatever it is, as if that would allow you to better understand the opportunity that presents itself. And I'll never forget, as a quick aside, back in my Fidelity days, having an argument with one of the portfolio managers who will remain nameless, but gold was going up, and I was talking about how it made a lot of sense, and he was telling me, well, he was basically arguing why gold shouldn't be going up, and I'm like,
Mhm.
that's not the argument we need to have. It's like, it's
Yeah.
working. We should own things that are working and not own things that are not working.
Yeah,
So,
I think that applies a lot kind of similar to fundamentals. There can be catalysts behind the scenes, like what that PM was probably talking about, and
yeah,
recognize that's important. And
sure,
when the market moves, maybe it'll have an exacerbated move because those factors now matter. And I think
yes,
we see a lot. I spend a lot of time talking to advisors about the AI stocks. I'm really very concerned with that space because I think the fundamentals there have
mm,
turned, and I don't think the stocks have recognized it yet or the price action yet, but the behind the scenes, there's a lot of cracks that we're watching on our side in the AI theme. But I forget what famous trade, maybe it was Paul Tudor Jones said the trend is your friend until it bends at the end.
yeah.
And now it hasn't been yet, but I think we'll see it eventually.
I think that might be an Ed Secoda quote.
Is it
He's
just
the
Dakota?
guy
Yeah,
that would do all the banjo, and yeah, I'm pretty
he
sure
was a
that
big
was
trend
him.
trader,
But
CTA trader. Yeah.
yeah. But an awesome quote. Whoever said it, it's a good one. Well, I have to ask about cryptocurrencies. Cryptocurrencies have all sort of ruptured. Is that something that you focus on at all?
Mhm.
Have you made a decision not to, or how? And so, two questions. I mean, number one, Bitcoin and Ethereum both have kind of struggled. Bitcoin testing 100,000, which I know has a lot of people nervous.
Yeah.
So, what's sort of your take, if you can share it, and also
Yeah.
just how do you think about allocation to something like cryptocurrencies? Is it similar to a gold commodities play, sort of an alternative asset, or how have you sort of incorporated into your own thinking?
Yeah, I think if we brought all the chartered market technicians, all the chartists together and said, okay, we're going to create an asset class that's perfect for us, what would we create? It would be crypto. It's an asset that has absolutely no underlying value. There's no cash flow. There's no earnings reports. There's no insider activity. There's nothing but purely buying and selling of an abstract digital whatever.
It's a petri dish for investor behavior, right?
Yeah, it is not to call it perfect, but it responds beautifully to technical analysis because there's nothing else to it outside of the news, whether Trump announces we're going to make it, we're going to stockpile it, or so outside of the day-to-day maybe announcements, it responds to price and demand. There's no dividends involved. There's no whatever. And so, yeah, I think I do a lot of charting on Bitcoin. It is an asset class we do own at different times within our portfolios now that we have ETFs to get exposure there.
Sure.
So I'm happy to own it because I think it at times can offer some correlation benefits. It can offer, if you're fairly active in it, some nice potential for return generation. And so, yeah, we're involved at times in some of the ETFs. And so, yeah, I think Bitcoin's really interesting. It has great charting characteristics. So as a technician, it's something that I want to keep on my screen for potential setups.
I feel like it's even if you don't invest in it directly, it's such a fantastic proxy for speculation, just for all the reasons you described, Andrew. I mean, it gives you a sense of those speculative pressures. And it's one thing that concerns me now is I think, Bitcoin, Ethereum failing in a way that we're not seeing in the equity indexes. Not giving me warm and fuzzy feelings here. So to finish off, this has been awesome, Andrew. I can't thank you enough for sharing some really great thoughts with us. Just as a final question, what's your one chart you would have? I mean, you look at a ton of charts every day, a ton of charts every week. If you're concerned about where we're at and you're worried about a big Q4 sell-off, what would be that one chart you would have in front of you just to validate, okay, this is a problem, I need to take action? What would that be?
And if I'm only going to watch one chart, it's probably just going to be a weekly chart of the S&P 500. Just because, it's whatever that's doing, it's going to be telling you the summarization of what everything else is doing. Yeah. I would say you could even narrow it down to even OEF or just the S&P 100, since that's really kind of what's driving the S&P 500. So I think just looking at weekly charts are extremely valuable. A lot of technicians will look at monthly. I don't think monthly. I think it's too much smoothing for me. So I look at daily, weekly, don't get into intraday stuff. But I think if I'd look at one chart, it'd be probably the S&P 500 and a 40-week moving average, which is like the 200-day if we were on the daily, and just keep it simple and kind of watch the trend and watch for when that trend starts to bend.
It's an awesome answer. One of my mentors and someone I know you know as well, Ralph Akampora, one of the founding members of the CFT Association, told me years ago, if you know nothing else about the markets, know the chart of the S&P 500. So he would appreciate your answer there as well. Andrew, listen, this is awesome. Great to see you again. I hope we can make it a little less infrequent. Hope to have you back on the show sometime soon. But for now, thanks for sharing some thoughts with us today.
Thank you.
Hey, thanks again to Andrew Thrasher joining us on the show today. I mean, really thoughtful comments all along the way. Getting to his background at the beginning, we talked about, how he had an early mentor that was a big fan of technical analysis. And that's been a consistent theme with a number of my guests here on the podcast, right? Sort of that person that introduced them, handed them a book about charting or something, handed them John Murphy's book, and that kind of set them up on this career-long journey to explore technical analysis. Andrew and I both sort of made our way to the CMT programs, which is where we really sort of elevated our use and our understanding of technical analysis. I really loved, and we talked about process, Andrew's commitment to market breadth indicators. We are kindred spirits for sure. If you follow my market recap show, we talk often about breadth conditions, and I know Andrew often shares some great charts and comments based on market breadth conditions. Really appreciated his thoughts about what that means here in November of 2025 after we've had a market that's been driven by arguably narrower and narrower leadership, which means weaker and weaker breadth conditions. Andrew's Dow Award-winning papers about volatility and about market tops, that 5% canary paper. I would encourage you, if you're a CMT Association member, you should check out that research because it was really, really well done. And I know he will make some noise if we do get that 5% trigger, as he thoroughly researched in preparation for that paper. But love that thought. I mean, in terms of he really focused on risk management with both of those, right? Looking for quieter volatility before spikes in volatility. I think there's a lot of wisdom in that, trying to get ahead of volatility spikes. But then also looking for price behavior at major tops, and that 5% down move is something I'll certainly be looking for in the weeks and months to come to confirm some sort of major market top. Overall, I mean, I think Andrew's comments about the current market environment, about how to think about stocks, how to think about precious metals, how to think about cryptocurrencies made a ton of sense. You can really get the sense that Andrew's process, right? If you listen to it, Tuesday's breath day or sentiment day, Wednesday's breath day, whatever the days were, Sunday's my research day. Successful investors, successful strategists that I've worked with and worked for and have worked for me have great answers to what's your routine, right? What's your process? It's not just, well, maybe I'll look at this thing, and then if something else pops up, I'll look at that. That's what amateurs do, right? It's the shiny object syndrome, right? Something is interesting, and so you go and do that for a while. For Andrew, it was every Tuesday I look at this same set of charts and then I write this report. Final comment I would make on Andrew's interview, which again I hope you enjoyed, I certainly did, was that the wisdom of writing, right? Writing a blog. He started a blog before it was cool to do so. Andrew's blog was one of the first, really focused on technical analysis and breadth conditions, and I think he's a great writer and certainly a really thoughtful investor. But I really like that for younger investors. When I talk to college students, when I talk to people just trying to break in the industry, I always tell them, start a blog. It doesn't cost anything, costs almost nothing to create a blog. You don't have to ever share the link with another human being. Just get your thoughts down. It will be date stamped and time stamped. We will be able to see down the road, if you go to apply for a job I'm hiring for, I'll be able to see what's your process. How do you articulate an investment thesis? What do you do when you're wrong? Because you're going to be wrong sometimes. How do you deal with that? How do you move through that? So I would encourage you, if nothing else, if you're just getting started, if you're younger, if you're newer in your investing journey, start a blog, right? And just get your ideas and your thoughts down somewhere where down the road, even if you may have the opportunity to share it with someone else. Thanks again to Andrew Thrasher of Thrasher Analytics for giving us some time today. Great interview, and hope we can get him back on the show here down the road. By the way, if you like this discussion about technical analysis, about process routines, and you want to upgrade your own use of the technical analysis toolkit, develop your own routines for investing success, that's why we designed our Market Misbehavior Premium members, to give you a little mentorship, to give you some encouragement and some accountability. 3 great benefits to the premium membership. First off, courses. You'll have access to all of our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral finance and technical analysis tools. You'll have access to our member-only reports like our weekly flight plan, which we put out every weekend. What did we learn last week? What was new? What was different? What stands out in the week to come? What levels, patterns, and signals are we looking for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member-only community. This is a small and mighty group of like-minded investors learning as they go, trying to apply the lessons of technical analysis and behavioral finance every trading day, asking questions, encouraging each other. I'm in there every day answering questions, sharing some charts and ideas, and we'd love to have you as a premium member and join us in that community, along with all the other benefits as well. For more information, go to marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller, here to remind you it's always a good time to own good charts.